The global economic order that has shaped international trade, finance, and political alliances for decades is facing profound strain as the United States and several of its closest allies confront growing divisions over economic integration, security, and trust. Recent events have underscored how long-standing assumptions about globalization, once promoted as a source of shared prosperity and stability, are now being reassessed amid concerns that economic interdependence may have become a source of vulnerability rather than strength. At the center of this reassessment is the United States under President Donald Trump, whose policies and rhetoric have prompted allies, investors, and policymakers to brace for rising economic risks in a rapidly changing world. The open split that has emerged between the United States and some of its traditional partners highlights the scale of the transition now underway. For decades following the Second World War, the global economy operated within a U.S.-led framework that emphasized open markets, integrated supply chains, and collective security. American policymakers promoted global economic integration as a path toward peace and prosperity, encouraging trade and financial ties that bound nations together. That system delivered efficiency and growth, but it also created deep dependencies that many governments are now re-examining in light of shifting geopolitical realities. Foreign leaders and investors are increasingly reassessing their exposure to the United States, placing greater emphasis on avoiding geopolitical risks that they believe have intensified as U.S. policy has become less predictable. Concerns are not limited to trade alone, but extend to finance, security, and the institutions that have underpinned global cooperation for generations. The reassessment reflects a belief among many allies that the United States is no longer a consistently reliable anchor for the global system, a perception that has been sharpened by recent confrontations and policy threats. Commercial ties between nations once made the global economy more efficient, allowing companies to lower costs and consumers to benefit from cheaper goods. However, those same links also created points of vulnerability. Governments, including the United States, have increasingly used tariffs, financial sanctions, and supply chain restrictions as tools of economic pressure. President Trump's recent threat to impose tariffs on European allies who opposed his plan to gain ownership of Greenland brought those vulnerabilities into sharp focus. The episode highlighted Europe's economic dependence on Washington and demonstrated how integration could be leveraged as a form of coercion. That confrontation placed significant economic interests at risk. Transatlantic trade worth nearly $1 trillion was exposed to potential disruption, as was a proposed new trade deal between the United States and the European Union. That agreement included $600 billion in promised European investment in the United States. Although the immediate crisis passed, the episode left a lasting impression on Allied leaders, many of whom stated that they would not allow their countries to remain exposed to similar threats in the future. The sense that a fundamental shift is underway has been echoed by economists observing the changing landscape. Neil Shearing, chief economist for Capital Economics in London, described the moment as a turning point defined by power, dependency, and coercion. He said there would be a concerted effort by many countries to reduce their strategic dependence on the United States, reflecting a broader move away from the assumptions that once governed global economic relations. The post-war global economy rested heavily on American leadership. The U.S. Navy secured sea lanes that enabled global trade, allowing massive cargo ships to move goods safely across oceans. Investors treated U.S. Treasury securities as a risk-free asset, confident in the stability and predictability of American institutions. This foundation supported decades of economic expansion and integration, reinforcing the central role of the United States in global finance and trade. That role is now being reshaped by an unapologetic, America-first approach. Under this posture, the United States has demonstrated a willingness to use its economic and political power to pursue national objectives, regardless of the impact on global goodwill. This shift has unsettled allies who had grown accustomed to a rules-based system that balanced American leadership with multilateral cooperation. For investors, however, economic considerations have so far outweighed political concerns. The strength of the U.S. economy, bolstered by rapid growth in artificial intelligence, has continued to attract capital. Financial markets reacted sharply when President Trump threatened to seize Greenland, with stock and bond prices falling. Those markets recovered within days after the president announced what he described as a framework for a future deal involving the mineral-rich island. The episode illustrated how quickly markets can move past political shocks when economic fundamentals remain strong. Despite this resilience, analysts warn that the United States' new posture and the response it has triggered among other nations will leave lasting effects on the global economy. Many countries are beginning to prioritize resilience over efficiency, seeking to reduce exposure to external pressure even if doing so raises costs. This gradual shift away from a rules-based global order toward a system dominated by great power competition is expected to reshape investment patterns and economic relationships over time. Abandoning established norms in favor of a more fragmented system could raise the cost of capital, challenge the fortunes of some American businesses, and increase the prices of commodities needed to build redundant supply chains. The effects may not be immediate, but economists say they are likely to accumulate as nations restructure trade and investment flows to reflect new strategic priorities. Signs of this transition are already visible. Over the past year, as concerns about U.S. economic and security policies intensified, the price of gold rose by nearly 80%. Gold has long been considered a refuge during periods of uncertainty, and its rise reflects broader unease about the stability of the global system. In Europe, calls have emerged to reduce reliance on U.S.-based financial infrastructure. A member of the European Parliament recently urged the European Commission to develop an alternative payment system to replace Visa and MasterCard, warning that access to existing systems could be cut off abruptly. Commodity markets have also responded to the changing environment. Prices for materials such as copper have risen more than 30% over the past year as countries invest in domestic production of semiconductors and pharmaceuticals rather than relying on imports. These moves reflect a broader effort to build self-sufficiency, even at higher cost, in response to perceived geopolitical risk. Doubts about U.S. reliability were present even before the Greenland dispute. According to Adam Posen, president of the Peterson Institute for International Economics, foreign central bankers and finance ministers privately worried that the Trump administration might interfere with Federal Reserve tools designed to support other countries during financial crises. Those tools, known as swap lines, provide emergency dollar liquidity to foreign central banks, but concerns have grown about whether they could be politicized. These anxieties have been intensified by a series of U.S. actions and threats that have left foreign officials uncertain about what to expect. From military interventions to territorial threats, the range of U.S. behavior has contributed to a sense of unpredictability. President Trump's repeated threats to dismiss Federal Reserve Chair Jerome Powell have further inflamed those fears, raising questions about the independence of key institutions. As these concerns have spread, Federal Reserve officials have taken steps to reassure foreign counterparts, according to individuals familiar with the discussions. Still, the erosion of confidence has begun to show in financial indicators, including shifts in currency markets and bond spreads. These developments signal that the global system is entering a period of adjustment, one that could redefine economic relationships built over generations. In the next part of this report, we will examine in greater detail how these doubts are reshaping financial markets, capital flows, and the behavior of governments and investors as they respond to a changing global order. As concerns about the reliability of the United States have deepened, their impact has begun to surface across global financial markets and among institutions that once relied heavily on American leadership and stability. While public reassurances have been offered, private doubts among policymakers, investors, and central bankers reveal a more complex and uneasy adjustment to the evolving global environment. These doubts are shaping decisions about currency exposure, investment allocation, and long-term financial planning in ways that reflect a gradual but notable shift away from unquestioned reliance on the United States. One of the clearest areas of concern has centered on the role of the U.S. Federal Reserve and its emergency support mechanisms for foreign central banks. According to Adam Posen, president of the Peterson Institute for International Economics, foreign finance ministers and central bankers have privately expressed fears that the Trump administration could interfere with tools designed to stabilize the global financial system during times of crisis. Among the most important of these tools are dollar swap lines, which allow the Federal Reserve to lend dollars to foreign central banks when liquidity dries up. These swap lines have long been viewed as a cornerstone of global financial stability, ensuring that short-term disruptions do not spiral into broader crises. However, uncertainty about whether these mechanisms would remain insulated from political influence has unsettled foreign officials. The concern is not merely theoretical. Posen said that discussions are now taking place among foreign governments about the possibility that access to emergency dollar funding could be conditioned on political or strategic concessions. Such fears have been heightened by a broader pattern of U.S. behavior that has left allies uncertain about future actions. According to the article, foreign officials have observed that the United States, under the Trump administration, has demonstrated a willingness to take aggressive and unpredictable steps on the international stage. These include military actions, threats to seize territory, and sharp rhetoric directed at allies. Together, these actions have contributed to an environment in which foreign governments say they can no longer assume continuity or restraint in U.S. decision-making. President Trump's repeated threats to dismiss Federal Reserve Chair Jerome H. Powell have added to those anxieties. The Federal Reserve's independence has long been considered essential to both domestic and international confidence in the U.S. financial system. Any perception that political pressure could influence the central bank's actions has raised alarms among global investors and policymakers who depend on predictable and rules-based monetary policy. Once these concerns became apparent, Federal Reserve officials moved to reassure foreign counterparts, according to a person familiar with the discussions who spoke on condition of anonymity. These efforts were intended to reinforce confidence in the Fed's commitment to its international responsibilities. Nevertheless, the article notes that even temporary or partial erosion of trust can have lasting effects, particularly when alternatives are available. Evidence of shifting confidence can be seen in currency markets. The US dollar has declined against the currencies of smaller advanced economies, including the Norwegian krone and the New Zealand dollar. While such movements can be influenced by many factors, they also reflect changing perceptions of risk and reliability. At the same time, changes have emerged in bond markets that suggest investors are reassessing long-held assumptions. Typically, even the most financially secure corporations must pay a premium to borrow money compared with the US government, which is viewed as the safest borrower. This difference, known as the credit spread, compensates investors for the greater risk of corporate default. However, that spread has narrowed significantly. Corporations are now paying just 0.72 percentage points more than the U.S. government to borrow, according to market data cited in the article. That figure represents half the spread seen 3 years ago and is the smallest since 1998. This narrowing suggests that investors may be assigning greater risk to U.S. government debt than they once did, or that they are seeking alternatives to traditional safe assets. While the article does not attribute this shift to a single cause, it underscores the broader uncertainty surrounding the future of the global financial system. At the same time, managers of government investment funds, pension funds, and central bank reserves overseas have begun adjusting their portfolios. Many are moving portions of their holdings into currencies other than the US dollar, rather than reinvesting maturing assets into new dollar-denominated securities. These changes remain limited in scale, but they signal a willingness to explore diversification strategies that were less common in the past. One notable example cited in the article is Akademiker Pension, a Danish pension fund, which announced it would sell $100 million worth of U.S. Treasury holdings. The fund cited concerns about the level of U.S. public debt as a reason for its decision. While the amount involved is small in the context of global markets, the announcement attracted attention because it reflects a broader shift in sentiment. Adam Posen noted that fund managers are now hedging against potential declines in the dollar in ways not seen since the 1970s or early 1980s. That comparison underscores the historical significance of the moment, even as most economists caution that the dollar's dominant role is unlikely to disappear in the near future. Indeed, the article emphasizes that these changes remain incremental. Despite periodic challenges, the dollar's status as the world's primary reserve currency is expected to endure for years, according to most economists. The depth of U.S. financial markets, the scale of the American economy, and the lack of a clear alternative all continue to support the dollar's central position. However, the global environment is becoming more competitive for capital. European nations and Canada are increasing defense spending, while also investing heavily in technology to keep pace with advances in the United States and China. At the same time, fast-growing Asian economies that once exported capital are increasingly using their savings domestically. These trends are contributing to tighter global financial conditions. Marcello Estevao, chief economist for the Institute for International Finance, said the world is moving toward an environment in which global interest rates are likely to be higher. He attributed this to rising demand for a limited pool of global savings, as more countries seek to finance rearmament, infrastructure, and technological development. These pressures have significant implications for governments, businesses, and investors alike. In the next part of this report, we will examine how rising borrowing needs, mounting public debt, and shifting political dynamics are intersecting to create new challenges for the United States and its allies as the global order continues to evolve. In the next part of this report, we will examine in greater detail how these doubts are reshaping financial markets, capital flows, and the behavior of governments and investors as they respond to a changing global order.